Thank you very much, everyone, for attending this session. We were kindly asked to come and have a straight talk around commercial insurance. And so, given that I know a number of you in the audience, we might have to pick out some to have some questions at the end. But look, when Joel asked us to come and have a conversation with you all, I was honored. Number one, because we get invited to a lot of different conferences, both local, national, and international conferences. And I have to say, this is about the only one that I actually think adds value. I say that in the nicest possible way, but it's actually the one where I think people come here to learn, to have conversations, and to kind of create some value in the industry. So it's a great pleasure to be up here having that conversation. I've got with me three panelists that representing both, as Joel mentioned, Canadian RIMS, Asia RIMS, US RIMS, and more importantly, from a client perspective, what the needs are and what are some of the changing dynamics that are going on in the insurance industry from a client's perspective, and also representing their members. So rather than me taking the time to read a bio, I'm going to do the lazy approach and pass it off to my colleagues on the stage here to introduce themselves. So starting with Darius on the far right, why don't you give a quick intro?
Well, thanks for having me. My name is Darius DeLon. I come to the risk management and insurance industry honestly in that I started as a insurance adjuster with Zurich, Canada many, many years ago, and then a commercial underwriter, and also a commercial broker before putting my feet into the risk management world. So from that perspective, I hope I can actually bring a well-rounded view to some of my comments and some thoughts. I'm also the past president of SARIMS, the Southern Alberta Risk and Insurance Management Society, and the just past chair of the RIMS Canada Council. Frank?
On to you, Frank.
Good morning, everybody. Bonjour. My name is Frank Barron. I'm the risk manager of International SOS, which is a company headquartered out of Singapore, where I'm coming from, as you can see on my face. I'm an Asian guy. I'm also the chairman of PARIMA, which is the risk and insurance manager association for Asia Pacific. So hopefully during this session I will be able to give you some insight about the way corporate insurance buyers out of Asia Pacific are valuing the insurance industry and are expressing their frustrations and the challenges we are facing, hopefully constructively. I'm almost now an insurance and risk veteran, but I've been a risk manager in a few companies across Europe and in the US, and I've been also deeply involved in insurance buyer associations in Europe as well, and very happy to share some thoughts with you today.
My name is Rick Roberts. I work for a diversified manufacturer, so I think what you'll get from us as risk managers is a varied view on how we all look at risk management. It's very different industry to industry, and as past president of RIMS, that was part of our charge, was to how do we educate across all those different business lines, those different business types, and give risk management people the tools they need to enhance their career. So my first job was with an insurance company, and I worked in the insurance industry for about 14 years, and I've been with Ensign Bickford, which I said is a diversified manufacturer, for about the past 20, and switched right from the insurance industry into risk management, and just think it's been one of the best career moves I could have made. I think in talking, you'll hear from us, really engaged in what risk management is and what it's about. So hopefully we can give you some views on where we stand on where the insurance industry sits in relation to how we're looking at risk.
And I hope how relevant the insurance industry is for where you're going forward. So that's the straight talk bit. Okay, so let's kick off with the next slide. Does that work? There we go. So I've just kind of put together this one as a precursor to the rest of the session, basically saying, between the insurance companies in the room, brokers, and more importantly, the clients, You know, the only way that we can continue to kind of add value is when the three of us all talk together. I think in the past, and considering the industry is 300 years old, you know, the idea of creating product and then relying on either direct distribution channels or through the third-party broker distribution channel to deploy that product, I think it's kind of coming to an end. We still see it a lot today. And I know there's a separate session going on the other side, focused more on personal lines, and maybe it's more related to that. But you'll notice on this slide, there is no technology component. You know, and we're going to talk a little bit about fintech. And my thoughts are out there in Vegas at the moment, where I know there is a big InsurTech conference going on, and I hope none of our colleagues are caught up in some of the disasters that happened last night. But technology just kind of, you know, is as a byproduct of the three units here coming together to create value for the industry. So I just kind of wanted to give that as a kind of a thought process, you know, moving into these sessions. So I recently had the opportunity to chat with a number of the CEOs from insurance companies, and, you know, talking around the Nat Cats of 2017, you know, the Atlantic hurricane season looks like it could be the costliest ever. We've had earthquakes in China, Mexico, and Italy this year, and yet there still continues to be more capital flowing into the marketplace than ever before. We've heard conversations from a number of insurance companies around the hardening market, and I think a number of us would love there to be some sort of stabilization in the market, not necessarily, and including clients. You know, the expectation that we're continuing going through a soft market cycle for another decade is quite frightening. And yet, even with all the Nat Cats that have gone on in 2017, we're still seeing a significant amount of capital. And there are views out there that more capital will flow into the marketplace because they think that there may be a slight push on rates, and everyone's going to dive back in and try and get some of that uplift. So if that does occur, then again, the soft market continues. So, you know, it hasn't so far, and we're going to wait and see how the year plays out, but it doesn't look like at the moment that we're going to start to see any significant change on a global basis. So a quick comment on InsurTech. I've put here, you know, revolution or regeneration. InsurTech is a fantastic, you know, phenomenon. You know, whether it's fintech or InsurTech, and we've had a brief conversation, and we might want to delve into it a little bit later on, around what it means for clients. From my standpoint, you know, the industry is 300 years old, and it has not really evolved very much in that, you know, period of time. A lot of people have put commentary out in the marketplace, and we're kind of setting the stage here, is to say, you know, is InsurTech going to disrupt the market? Is it going to, you know, make the broker irrelevant going forward? Could it make the insurer, you know, disrupt the insurers? You know, do we automate all underwriting? I think there's some fantastic technology that's coming about. Insurance is a lag industry. It's driven by demand, not supply. The innovation component that, you know, generally comes about is through clients expressing a need to transfer risk, and then the capital markets coming behind that to create product. The InsurTech guys are actually changing that and flipping it on its head a little bit and creating a lot of efficiencies in the marketplace. And you'd be surprised the amount of capacity and capital that are flowing into some of these young teams and what they're able to develop. So it's an interesting area. We're going to open it up for questions later on, and I'd like to, you know, maybe throw some of those questions back out to the audience and where you think that's going. From a client's perspective, we'll probably touch on that at the end. We're going to move on to another topic.
I'd just like to add, if possible, there. My opinion, is it InsurTech or is it something else that's going to disrupt the industry? But if you still look at the insurance transaction from us as buyers, it's the most inefficient transaction that we have to deal with on a daily basis. And the time involved in getting a renewal done just to me seems absurd. You know, you've got to start 90 days in advance is the recommendation, and you can't get quotes until 15 days before because underwriters are just swamped. So right now it's a very cumbersome process. And that's even for somebody like us. We've been with some of our insurers for 20 plus years. Why do we have to start 90 days in advance? Don't you know us? You've been with us for 20 years. You know, it's a relationship business, but there still is, to me, a disconnect in that business relationship. So I don't know a whole bunch about InsurTech yet, but I think there will be something that comes down the road that will disrupt how the industry interacts between broker, insurer, and risk manager.
Well, why don't we delve into it a little bit now then, you know? So, Frank?
The thing for me, and I partially agree with you, Rick, and partially disagree, the thing is that I think that the process we are in when you're a corporate insurance buyer, when it comes to the negotiation with carriers, with the support of your brokers, and the renewals and stuff, will continue to be very heavily manually driven, because it's like haute couture. It's something, as corporate buyers, we want something very specific to cover our risks, and I think that we'll continue to have these kind of ad hoc conversations with the different parties on the line to make sure at the end we have the right protection, the right financial protection. This is where I think the industry is facing a challenge. I just want to make sure that at the end of this very long and cumbersome process, we really have a customized solution to my risks, to the risk of my corporation. I'm not that sure that it's really happening right now, and I'm not that sure that we are improving this. So if at the end of the day, going back to your point, Rick, it's a very inefficient process to renew a policy, and at the end of the day, we do not have a hands-on type of protection, but more kind of standard product, then yes, it's a failure. It's something that we need to fix. But I keep the point that I would like to continue to entertain the ability to access people like you, where we can have a business-minded conversation about these are my risks, this is the way we are managing them, and this is the type of specialized or customized protection I would like to get from you.
And I agree with your point in that the face-to-face can't go away, but there's a lot of noise in between that can be gotten rid of. So I agree with you totally on that.
So looking at it from my perspective, and I had an opportunity to rent a couple cars over the last 2 days, and one of the places I rented a car, they came to me and said on an iPad, "Is this you?" "Oh, it is? Okay, sign here, sign here, sign here." And I was out with my car in less than 5 minutes. They didn't really know me, but they perceived to know me. At the other rental place, they said, "Oh, you know, this is the first time we've seen you. We don't know who you are. Please read this, do this, fill in this." And it's about a 15-minute process. And like Rick talks, you've known us for 20 years. Why do we get the same questions over and over again? Why isn't there any ability, and perhaps through InsurTech, to say, "Hey, is this you? What's changed on this? Let's work to that." And then not make it a 90-day process, running around, answering more or less the same questions each and every year on a renewal, and shrink that process, and perhaps through shrinking that process, have efficiencies on the other side, on the underwriting side, that allows you to actually look at more new business renewals in a more comprehensive manner, because it does seem like commercial underwriters are under the gun. You know, they're maybe, Rick, you're lucky, you get it 15 days beforehand. Who hasn't had it the day before, right? And if we're doing these kind of transactions with that kind of dollar value the day before, it gives me concern.
So I'll do the straight talk here. I don't think anyone gets their policy on time properly.
I still don't have my July 1 renewals in hand yet.
No, we had an example recently. We did an end-to-end process, and I think, from the start to the end, it was like 300 days before we had a final correct policy from that year. And I think, if we look as an industry and say, all right, that's appalling, and it's not anyone in particular, but you hear from a client saying, my business. Yet at the start of every renewal, the same questions kind of come back. And you've got that same delay process on getting that information from a client to your intermediary, and then back to the carrier. And there's, at points during that cycle, there's errors being made. And then it goes back and forth. And I actually think it's, we aim for 180-day kind of ahead of time just to get ahead of some of those curves. and it's very rarely that, you know, we're able to get a proper policy out of the insurance companies.
Let's be honest, Ron. We made some, as a global community or global industry, we made some significant improvements in terms of contract certainty, and we have some regulations here and there in the world that helps this to happen. It's not yet great. If I look at my corporate insurance program for a company headquartered out of Singapore, we have corporate policies being issued in the US, in London, Paris, Frankfurt, Australia, Singapore, etc. So I do have a kind of fair visibility on the efficiency of the industry. It's a total disaster. It's not working at all. I mean, I can tell you that my main program, I'm in the medical and security services or professional services type of business. So you can imagine quite easily that the casualty, the liability aspect of our programs are very important. My programs renewed as of 1st of July. I'm still waiting for my corporate insurance policy to be issued. On top of that, I'm still waiting for the insurance premium invoice to be issued. And I think it's a complete disaster because for a company, if you do Finance 101, you're going to know that we don't care about paying as of 1st of July or the 1st of October. This is budgeted. This is accrued for each and every month. So there is no real merit or real benefit to us to wait. So if you go back to markets like Japan, where you have this famous cash before coverage thing, I would love to have coverage before cash thing happening, so that we know that everybody is going to be on his toes about, okay, let's make sure we provide the product to the client. And I think that for me, it's a very important point. What is the real product to us? There is two ways to look at it for me. The first product is this insurance wording thing, this policy. Is going to be, for us, the way to say, we have a deal, we have an agreement. And obviously the second product for us is going to be the actual claims payment willingness if there is any claim or losses triggered by this policy. But the very first one is this insurance wording. Again, when you are in a risk management department and you try to, let's say, make your insurance programs as visible as possible to your top management, and I think that's the duty of risk managers, is to promote it at the right level. Having a very inefficient, let's say, collaboration with the insurance industry does reflect quite badly on us. And this is something that we would like to fix. I'm trying to fix it as an individual risk manager, as a chairman of a risk manager association, but it's still a struggle. And I think that within your industry, your part of the industry, sorry, there is still an acceptance that it's okay. Let's be honest, this is not okay.
And I'll just tack on, our CFO, when a decision has to be made, they don't want to make a decision in 2 to 3 days. So to your point, if you get an invoice or you get your quote 2 to 3 days before it renews, that's putting the CFO and the senior management of our teams in a bad position, quite honestly, because they want to dig into the details. So we really need the information 30 days in advance to have those discussions and be ready to put the policy in place 30 days out from that discussion. So to all the points we're talking about, there should be a regimen, but it can be tightened, and especially for renewals with an existing insurer that you've been with for a long time. I don't see the process needing 90 days. I don't see it needing more than 30 or 40. So but it's still a long way to get there.
So if there's a takeaway from that, and we somehow tie this back to the fintech piece, is if fintech can help start to create more efficiencies within our industry, then I think it's a big win. And I think if we were able to collectively, all the different components, start looking at, all right, should we have KPIs in place? You know, should we be holding our broker, our insurance market up to certain standards where we say, all right, we're going to commit to a certain delivery time. There are some markets that can do it, don't get me wrong, and they sell on that basis. But as an industry as a whole, the contract certainty piece is a key one, but actually getting correct documents in time, up front, should be something that we should all aspire to, and it seems pretty basic. So let's have that as a takeaway. Okay, so moving on to, now, for those in the back of the room, you probably can't see that, but you can see the color coding. So I'll kind of talk you through it. So every 2 years, we've used the Aon survey here, but we could have used the Allianz survey, we could have used the Marsh survey. They're all pretty much the same. But every 2 years, we kind of, we reach out to all our clients globally and ask them to identify all of the risks in their business. And then we categorize those 1 through, in this case, we're showing 55, there's 200 of them odd. We're going to concentrate on the top 10. But one of the reasons I put this slide up there is we've categorized those risks as basically green is an insurable type risk, the light blue is partially insurable, and then the dark blue is generally kind of this uninsurable type of risk that our risk managers are viewing every day. And if you just look at that, you know, it's quite interesting with the amount of capital coming into the marketplace. What is that, you know, how does that feel, you know, to you, Rick, you know, when you see that?
I'd change the uninsurable to currently uninsurable. A lot of those dark blue risks probably can put a financial product around them. And to your point, you could use the capital that's out there to start helping develop risk programs around these types of risks. Maybe it isn't that it's a pure insurance product. Some things we were talking about, the reason we did just buy cyber risk after a 7-year endeavor trying to find anything that had actual coverage in it. That would be a process, you know, if you had service offerings that you could provide instead of a pure insurance policy, much like what International SOS does. They offer medical response and emergency response, and then you can build insurance around that, but there's a key service offering there.
Thank you. Thank you for the free advertising.
You got it. Some similar things could be used on the current capital that's out there to build programs around these. It isn't necessarily a pure insurance product. And I think the insurance industry is well suited to do that because of all the expertise you have in-house and what the brokers bring with everything that's been studied. So a lot of the good programs that are out there around business interruption and contingent business interruption, all those things that have been developed over the years, they're great programs and they do work. Provide similar type solutions to these dark blue boxes and then enhance what's in the light blue boxes to help the risk management community and the commercial buyer.
It's an interesting list of risks. I started my first enterprise risk management program when I was working for a French company called Danone, food and beverage company, in '99. And when we issued our first global risk map to the top management and to the board, we mentioned to them that 80% of the risk were not insured. I think that the percentage remains more or less the same. Maybe the risk changed over the years, but this is, for me, a striking aspect of our industry. And I say our industry because as Bayer, we are part of it, is our inability to accelerate the process of developing products or accelerate the allocation of capital to new risks. Because new risks are happening and the speed of it is accelerating. So we need you guys to be more flexible. We need you guys to be more responsive in a faster way to respond to our risk protection needs. And I know that it's not easy because you need to have your facts right, your science, your underwriting process, and etc. But what should be done by you to make it happen? I mean, if you go back to other industries, like in the phone industry and even the media industry and plenty of others, they went through these challenges of accelerating the delivery of new products, investing much more into the research and development, R&D, etc. We are going to talk about big data later on, but how can we help you, or how can you help us to develop protection, to develop capital allocation in a faster way so that we can respond to the financial protection needs that we are facing within companies? Because don't get it wrong. At the end of the day, we are making, for let's say the the risk-aware organization, we do this risk appetite conversation almost on a daily basis, which is about, do we retain? I mean, is it a real risk to us? How is it going to impact us? How can we prevent it? How can we protect it? How can we finance it? With obviously the ultimate goal to be better resilient as an organization. But the thing is that most of the day, when we have an issue in terms of a new risk, we are saying, okay, we are going to retain the financial consequences of it for the time being because we can't find any solution. So maybe to challenge you back a little bit, Rohan, on what you said at the beginning. Yes, there is a huge amount of capital available to us, but it's usually on very basic and standard products. Very difficult to find people who are saying, okay, I'm going to structure something that is going to fit your needs in terms of risk. We are going to talk about the cyber later on and reputation and this kind of thing. So how can we better protect organization with you guys? That's for me one of the challenge we have. And how can you support us? Because most of the time when I have a conversation with my board or my executive committee, they are telling us that the solutions provided by the insurance market are not sufficiently, let's say, relevant to our risk exposures.
So I would also, I just add to that, and then we kind of move on, and I'll pass it off to Darius. But one of the challenges that we have when speaking to clients is understanding where the insurers are in that cycle. So a lot of the time at the moment we see, to your point, there's a lot of capacity, a lot of capital in the marketplace. However, the box seems to be getting smaller at the bottom end. The product seems to be getting narrower. And maybe that's because we're tying it back to contract certainty, or we're just tying it back to underwriting results. So a lot of those fringe risks that we see that may have been covered in the past seem to be disappearing. And actually, the needs of the clients is to start looking holistically at the enterprise risk management kind of framework and saying, all right, can we start to create a bigger box, to create more products that respond in different ways, rather than narrowing it right back down to an individual, and we're back being insurance salespeople, just selling a product to a client. And I think that's the challenge to the industry, particularly to clients like these, which have global remits, large exposures, is to start to say, all right, enterprise risk management now, how do we make that box bigger? How do we cover it off? What are the triggers? Do we need such defined triggers as we've had in the past? And look at it in a different way. And I know some people are trying to do it out there. It's a hard one to place. I think it's a challenge to us all as an industry.
Rohan, could you bring back that box on the PowerPoint?
You can. I think, let's go back one.
Go back.
There we go.
There we go. I was the AVP for risk for Mount Royal University. And our president there wasn't very risk aware, wasn't very insurance aware, but I remember presenting him with our ERM policy statement. And one of the things that he questioned me on was, well, within this statement, you mentioned risk 6 times. Where's the opportunity? What are the opportunities that we as a university are looking at? And I look at this box the same way. There's 14 out of 55 areas that are currently insurable from a risk manager perspective, right? And some are done very well. Some probably have some room for improvement. Some have some risk control elements that we actually buy that insurance for the purpose of that risk control. But there's then 41 areas within this box where there's opportunity for the insurance industry to respond to what's needed. And I don't think these opportunities are for every insurer in Canada or the US to actually respond in kind. I think some of these are niche markets that if you were to take a real close look at the opportunities that are available, a survey, perhaps it's just the risk managed accounts, or perhaps it's the mid-market accounts that need it. But there's opportunity to not just provide a financial vehicle in case of a loss. And Rick said earlier with regards to cyber, we bought, when I was with MRU, cyber years ago. I didn't buy it for the coverage. The coverage wasn't very good. I bought it for the expertise. And as we joked yesterday, because someone's going to also figure out how to buy Bitcoin so we can then actually pay our ransom. So there's a lot of things that are unique to the industry that once you actually do 1,000 claims, you know how to do them well. Me as a risk manager, if I've never had a ransomware claim, I have no idea how to respond. So I look to the insurance adjusters as incident responders. Sometimes they're very narrow incident responders, and maybe that's okay for certain incidences. But sometimes they're very broad incident responders, and you want to bring them into your emergency operations center. So when an insurer is in a partnership such as that, they add a lot more value to a risk-managed account. We can count on them and say, well, what do you think in this situation? And if you have people that are willing to actually provide us with real-time information in a critical incident scenario, that's very, very valuable. And that can differentiate one insurer from another. And I'd love to see more competition from the insurer ranks on providing more service as opposed to just maybe necessarily more capacity. Because it seems like everyone competes on capacity, competes on price. But I haven't really seen that competition on the service side, and I'd love to see more of that.
And I'd just add on the dark blue boxes again, my impression or my thinking would be that the insurance industry faces many of those risks, and you're handling them internally. Why doesn't that become a service to corporate buyers on what you do internally to mitigate the risks yourselves? That's a potential service offering to buyers of insurance, your existing customers. It could expand your business base with current clients.
So let's, in the interest of time, let's kind of delve into, so this is the top 10 for those people that couldn't read the earlier slide. That gives you kind of a little bit more clarity. Let's dive into the first one, damage to reputation / brand. So we've kind of, taken that and we've expanded it out with the other risks and said, all right, there's some interrelating type risks here because that was a partially insurable one. So Darius, why don't you kick it off and just kind of from your view?
It's interesting how we actually perceive reputation risk, or the risks to our reputation is probably really how we should look at it. I've seen a lot of examples, and just recent examples of a reputation that's been damaged by how organizations respond. I guess we can look at, if we name names, BP a number of years ago, on the initial response to the incident, or perhaps, or United on the initial response to the incident, and the damage to the reputation that occurs as a result of that. So some of the things attached to reputation here are how your reputation can be harmed. But some of the ways that it can be harmed is just through slow response, incorrect communication, right? And I guess this links back to a little bit of the services that could be offered through insurers that are also offered through some brokerages or broker partnerships, that sort of stuff. But it would be nice to actually see it across the board, a partnership arrangement where you can rely on someone to say, hey, we understand you have an incident, and here's our crisis communications response for you if you choose to actually use this response. I'm sure United would have actually had an easier time of all the negative press had they gone to an emergency operations center and said, hey, what's going on? What should we say? Instead of perhaps tweeting what we want to say. But there's, I'm sure, a very large experience base of what goes wrong and what goes right when you manage an incident, and I'd love to be able to tap into that.
Interestingly, the reputation is on the top of each and every risk rating that we do within risk managers associations around the world. If you go to the US, Canada, Europe, Asia, Latin America, there is a constant over the last 7 to 8 years. Top 3 reputation is there. To your point, I don't think that reputation should be seen as a risk. It's an asset. And as an asset, it needs to be protected. There is the way we manage things, the way we respond to incidents to lesser the damages to the reputation. But there is also the way we can financially protect the company. This is where becomes the challenge for the insurance industry. How do you agree on terms when it comes to reputation. You can be listed or not listed, but it's very difficult. There is a couple of products in the market. Most of them are not really responding to it. They are actually focusing on the PR, media aspect of it. How can you recover through the social media, through the traditional media, in terms of a situation you are facing? This being said, there is a few capacities coming in, especially with some parametric triggers, which helps to clarify this. We are not going to argue about how do we value the reputation. We are going to agree on certain triggers, and then the coverage can be done, can be provided. But here again, reputation for me should be at the core of the products or the solutions you are providing to us, not as the risk you want to manage, to insure, but how we can help our organization to be better. As you said, if you look at cyber insurance, there is good capacity now. Wordings are better. There is room for improvement, or otherwise we will not be on stage today. But the very first thing that cyber is providing to us, cyber insurance, is the incident response capabilities. I purchased my first cyber insurance policy in 2013. I was the first cyber insurance claim notified to the London market 3 weeks after the inception of my policy. I went through it. I can tell you incident response is very important. This being said, the way organizations are looking at risk and reputation as an asset is our ability, obviously, to respond to incidents, but it's coming from different, wide variety of scenarios. It can be a bad customer service thing like United, can be a bad industrial catastrophe somewhere, can be related to cyber, can be related to the disruption of your supply chain. At the end of the day, the challenge for us is the fact that it's becoming more and more difficult to identify all the scenarios, and it's becoming more and more intangible. And I would like to come back to this at a later stage. But yes, reputation is at the core of the conversation when we have a risk conversation with our leadership.
I'll just say, I really like this slide because in what RIMS has been talking about for years is that damage to reputation is not a risk, it's an outcome. And it's all these other items identified are what cause or a potential cause to your reputation being hurt. So to just say damage to reputation is a risk, you've got to really look broadly across your entire operation because damage to reputation can come from absolutely anywhere. And social media being identified there right now, that's hampering a lot of companies. And I had the good fortune of one time, I can't remember who the company was, Cisco, I think it was. They had a world map up when you go through their corporate headquarters. A world map, and it's just blinking lights at a ridiculous rate. And what it's showing is every social media hit that's negative to Cisco. I think it was Cisco. Their game plan was they wanted somebody to respond within 30 seconds to every negative hit they saw on that board. That's how critical their reputation was. So again, they're managing their risk through monitoring the social media to not impact the outcome of bad reputation. So I just like this slide because the reputation issue is an outcome, it's not a pure risk.
This being said, I think that because we have been asked to be very challenging with you guys today, I think that reputation is a risk for you. Your industry does have a very poor reputation when we are dealing with our top management and boards, and we're going to have to fix this because I'm still amazed. If you ask a group CFO, for instance, how many times you are meeting with your bankers on a monthly basis, they're going to tell, I don't know, once a week, once a month, etc. How many times are they meeting with insurers? 0. So when you map your stakeholders, financial stakeholders are obviously critical to all organizations around the world. Bankers are easily listed as the top critical financial stakeholders. Insurers are usually not there, and they should. And I'm pretty sure that the same to my friends on stage. I'm spending a decent amount of time at convincing and explaining to my top management that we have to treat insurers as critical risk financing providers, as critical financial stakeholders. But we start from very low, because usually when we talk about insurers, our top management does not have a very, let's say, a good feeling about it.
So, I mean, I think that's a fantastic kind of parting comment on that, because, you know, I'll use an example. Recently, we had a very large energy company, and the treasurer was seeing all the insurers. And, you know, the treasurer was used to sitting down with the bankers, with the lawyers, and had the opportunity to sit down with all the underwriters and talk about their risk. And I think there was 3 questions that came after the treasurer's presentation. And she walked away and said, well, that was a waste of time. And I guess the challenge is like, you know, how do we continue to make ourselves relevant? You know, the slide around the damage to reputation, I agree with you. You know, Rick, you know, it's not about the reputation, it's about all the other products, but we've got to stop selling the products. We've got to start looking at the service. Professional service firms is what we are. We're deploying our capacity and the needs of the clients. And if we don't find a way to change the attitude from the CEO, the CFO, the treasurer, and the risk manager, you become not relevant. You become a commodity, and then it's procurement that we're dealing with. And trust me, as a broker, the last person I want to deal with is procurement.
Correct. And it's been brought up in the previous discussion as well, all about cost of capital and how the insurance industry is monitoring their cost of capital. Our insurance purchase becomes part of our cost of capital. And our CFO and our finance people want to make sure that we're getting the right mix so that cost of capital is effective in their modeling. So when they're looking at letters of credit, we're constantly battling on, is a bond more efficient than a letter of credit? Perfect. Is an insurance policy more effective than putting a bond in place? So we've got to have that discussion, and the industry knows that better than we do on what is the efficient cost of capital within all those different product lines. That discussion to have with the finance people of customers would be very valuable.
I challenge you on whether or not we are actually. You know,
no, I don't think that discussion occurs.
No,
but it would add to the reputation of the insurance industry. Say, we're providing you very efficient capital when you know you're paying 10 cents on a 100,000, whatever it comes out to, $2 per $100 of insurance you purchase. That's a pretty good rate for a cost of capital compared to borrowing money and everything else. So if we can tie all that together and prove that insurance is the best efficiency for how to spend money to protect risk, that's a great discussion to be having with companies.
But don't get me wrong. When I said to you that your reputation is very poor, that's a fact. But it's unfair. I'm still, and I've been in this industry for 25 years. I'm still championing very strongly the fact that the DNA of our industry, the social and economic role of our industry, is critical to the capitalism. It's critical to the business around the world. It's critical to people who are suffering from natural events. It's critical to plenty of different things. And I think that we are not good at promoting it. I think that there is the value creation aspect of our industry is not seen, is not promoted to the business leaders of the world. So I guess that the articulated risk managers are trying to do their best to promote it. I do spend a decent amount of time at introducing CEOs of insurance companies who are working with us, with the CEO and the chairman of my company, for instance. But it requires a lot of energy and a lot of convincing to do it. And this being said, how many of the clients are doing it? Because for a lot of risk managers, they are not properly equipped in different aspects to make it happen.
Okay, conscious of time, we're going to let's jump onto cyber, because we've already talked about it briefly. We'd be remiss not to kind of mention it. It's the hot topic at the moment. There's a lot of insurance companies, reinsurance companies in the room that are either, have jumped in with 2 feet or are dabbling their toes in the water on cyber. One of the surveys that we did, and again, it's tough for you to do it, is to ask the risk managers, are they ready? in relation to any of the risks. And the cybercrime, hacking, viruses, et cetera, 79% of them said that they were. And that really depends across the industry, but they're all pretty high, which I was surprised at, because if you actually look at the amount of people buying it, it's still sub 30% of the client base. Now, it has increased a hell of a lot in the last couple of years. So why don't we go to the far side of the panel, Darius, and just make your comments around your experience with the cyber environment, what the insurance companies are doing. Over to you.
Thanks, Ron. It comes from personal experience with regards to the cyber coverage, and I talked on it earlier with regards to not really buying it for the actual insurance aspect of it. That's typical of reimburse me for the costs that I incurred, but for the expertise that comes along with that. The realization is that we can't necessarily negotiate well with a ransomware attempt. How do you do it? How do you make sure that you get all your data back? If there's a secondary password that's been encrypted within the data, so you don't have to pay a ransom once, a ransom twice, a ransom three times on the same incident. So I could see from the risk management account perspective more reliance on insurers and on brokers to say, hey, here's how you do it, and here's the all-encompassing product to get you there, right? Because the money, and I've seen some results of, depending on how you average this out and whose survey it is, but a average loss of about, or the mean being $1.6 million, but that takes into account some of the mega losses that are out there, but also then the middle or the median loss being like $25,000. So all those claims that happen being under $25,000. So that doesn't, convince you to actually buy insurance, right? Because half of all the losses are under $25,000, if that's a correct survey or not, right? I'm not going to debate that part. But it doesn't convince you to buy it, and it doesn't convince you to buy the limits. But it's the service that's important. If you can help out the industries that are out there by having a professional group that goes around and says, hey, here's what you do pre, and here's what you do post, right? And the pre is becoming very important in the industry. And if you just maybe take some of your capital, right, and invest it on expertise and approaching those that need the pre-assessment and the pre-work done on their exposure, that'll go a long way. Because at the same time, we all have CIOs that say, we're good, right? And I think your earlier slide talks to that. It's like, no, we're good. We're never going to be hacked. Whether that's Mount Royal University or Sony, right? And we know some of the biggest, some of the best, some of the brightest have been hacked. How did that happen? Right, so I think the targets are hacked, and it's just a question of time before they move down from the juicy targets down into the mid-market targets and into us. And I hate to see the day when we get a full-on attack similar to something like Sony.
Well, to your point, that was the day I knew we had to really start looking hard at cyber insurance and cyber risk management. Was the day our CIO said, we can't be hacked. He said, you've got your head with someplace where it shouldn't be, because we're going to be hacked at some point. And that's when we did start taking a real hard look at it. But as a manufacturer, and I mentioned before, it took us 7 years to find a policy that would respond to our risk. The initial policies that were put out there were really good for the financial institutions, because they had been the ones who had been hacked the most. So the coverage was very good for that. But as far as where we could be hit as a manufacturer, we really couldn't find a lot of coverage within the policies until this past year. And there's a couple of companies that are really building them for more for manufacturers. And to Frank's point, the day we put the insurance policy in place, I think we did have a hack 3 days later, but it was well within what we could control. But again, it woke everybody up on, look, we have all the protections we think we need in place, but somebody got in, and it was the age-old incident. A couple of employees clicked on a link they shouldn't have clicked on. That allowed the people to come into our systems. They got a few pieces of information. They were able to get information for just those 4 people that clicked on the link, but it proved again that the vulnerabilities come from so many places, and you can't control all your employees all the time. So now the thing we have going, and I haven't been caught yet, and I better not. They send out the fake emails trying to catch you. And you're immediately sent to training class if you click on the thing. So I don't want to hit that button.
There are so many things we can say about this one, but the very first thing for me is that our industry made a fantastic job at finding the very nice, juicy marketing name for it. And we say cyber, usually. But cyber does not really reflect all the dimensions of this. And if we were discussing while preparing this session, talking about the situation of Merck, the pharmacy company, the recent hacking situation they faced is potentially creating more than $1 billion US dollar of business interruption, inability to produce their product and to sell them. So it's not just about the liability, it's not just about the viruses, it's also the business disruption aspect of it. And it's true that the insurance policies available on the market are not yet able to respond to the magnitude of these kind of scenarios. But we should not fool ourselves. I mean, computer-based activities within organizations are everywhere. I would doubt to find one single industry who would not be impacted if their computer systems are going to be shut down, whatever is the reason for it. So this intangibilization of risk needs to be coped by your industry. On top of that, another comment for me when it comes to cyber. Interestingly, I do a monthly risk committees with the owner of the company. It's not a listed company, so I'm dealing directly with the owners every month on risks. The very first risk we talk about when it comes to cyber, it's the opportunity side of it, which is, are we going to be able to deliver our digital agenda? Are we going to be able to digitalize what we have to digitalize? That's interesting, but it means also that this is going to become our new norm for all of us, even for manufacturing activities, and we have to cope with it. So I'm looking at cyber insurance policies. In 10 to 15 years, will become the epicenter of our risk financing programs. This will include the property damage and business interruption, the data privacy, liability, incident response, and so on, because it's everywhere. I mean, the professional services arena, so obviously computer and ITIS is very important, but manufacturing and industrial companies are very relying on this. I mean, if you look at the success of companies like SAP with their infamous ERP systems, not SAP per se, but ERP systems around the world, a lot of our activities are relying on a few systems, and so our ability to be resilient when there is a disruption into this, not that great, I think.
I mean, from my standpoint is, this is, we're in a spot in the cycle where the insurance industry has got every opportunity to really set itself apart and show that not only does the insurance product respond, but those ancillary services that Darius mentioned, that most of the insurance products have already got lined up, actually work. And I think, so far, there hasn't been that many litigious cases that are coming to the table. And I'm hoping that the insurance industry continues down the route that it's gone, of creating, not only a product that responds, but all those other services, which, maybe those other services should be now just thought about as, built into other products, from that to reputation and brand, et cetera, crisis management firms, on retainers, et cetera, et cetera. So maybe there's some opportunity there. I'm not certain of where the time is on this. 3 minutes. So why don't we, before I pass off to our colleagues, is there any questions, comments from anyone in the audience to the panelists? It's an active audience. Go.
Do you see that cyber protection from the insurance companies should be provided as part of property policies or standalone? Do you see we will have both, or do you think one will emerge?
Based on my experience, it should be actually a cross-class kind of protection, because there is a liability component to it, obviously. We have the data privacy aspect, you have the credit monitoring, and there is a lot of different things that needs to happen when you have an incident. But obviously the property business interruption aspect needs to be recognized. So I'm pretty sure that potentially one of the future or the evolution of this policy is going to become a multifaceted kind of product, which is already the case. Yeah. But it's largely through the liability aspect of it, and then you have an element of business interruption, additional expenses kind of stuff, additional costs. But yes, for me it's combined. And that, I guess, it says something about the traditional aspect of our industry. It's difficult to come up with something that goes into the P and the C of our market.
Yeah, and I'd go across all lines, not just cyber and how it relates to property and how it relates to liability. As companies are going through enterprise risk assessments, we're looking at aggregating risks in ways that haven't been aggregated before. And to try and wrap an insurance program around that, it is a lot more challenging, because if you've got an all-encompassing ERM program, it's tough to start stacking monoline policies on top of your ERM program, because your ERM program crisscrosses across so many aspects of your business. So it isn't just cyber. It's a great question. It's how are we going to start blending across all lines of business so that there aren't gaps, natural gaps created between two monoline policies.
And what I'd like to see is actually maybe going back, if you will, to the dinosaur ages of, to the 80s or what have you, before there was so much coverage that was carved out of whether it was a liability policy, and then out of that comes a couple different buy back ends with regards to coverage or property or, or earthquake, flood being carved out, right? Terrorism being carved out. So all these pieces have been carved out and brought back to the table, and they become those monoline policies that we need to then make sure as risk managers that, well, I have the terrorism piece here, and how does that match up with my property, and how far off is it, right? And there's no overarching discussion on that. It's up to the individual, so whether it's risk managed or not, to figure out whether or not there's a gap, right? And you work with the brokers to try and figure that out. But yeah. I remember when terrorism policies first came out, they were horrible. They're like a fire EC policy of the new generation. What's that supposed to do? So, maybe it was a little bit of a knee-jerk reaction, and, there's a good reason for that. But, as we come forward, why are we not seeing actually some products being combined again? It's just a matter of rating. It's just a matter of having enough money. You can insure a burning building if you charge enough money for it. So don't charge me the full price, but, but I'm sure we can do it. It just bring some of those products back into one master product.
I think unfortunately we're out of time, but I just want to ask you all to give a round of applause to this fantastic panel. Rowan, Rick, Frank, and Darius.